Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
$241.90. That is the price of Western Digital as of the close today, Thursday, January 22nd, 2026. We are hovering just fractions of a percentage point below the 52-week high of $244.90. I mean, if you pull up the chart, you aren't looking at a slope. You are looking at a wall. The stock is up approximately, 352% over the trailing 12 months. The volume profile, well, it suggests heavy institutional accumulation. And the question we're wrestling with today is, it's simple, but high stakes. Is this move sustainable? Is Western Digital experiencing a structural re-rating as a critical AI infrastructure utility, following the SanDisk spinoff? Or are we just staring at a cyclical peak in a commodity market that is historically extended?
It is a massive move. There is absolutely no denying that. But when I see $241.90, I see a stock that is just priced for absolute perfection. We're talking about a $77.4 billion market cap for a company that, despite the shiny new AI narrative, still operates in a cyclical duopoly. I look at the technical extension. We're trading roughly 25% above the 200-day moving average, which is way down at 192.94. That is a historic level of overextension. In my view, gravity, it hasn't been repealed. This just screams mean reversion.
I get the skepticism when you're looking at a vertical chart, but I'd argue you're applying old-world metrics to what is a fundamentally new company. You have to look at the structural change that occurred back in February of 2025. The spinoff of SanDisk was the definitive catalyst. It didn't just slim the company down. It removed the conglomerate discount that plagued the stock for a decade.
And just to clarify for our listeners, the conglomerate discount, that's the penalty the market applies when a company is just too complex to value efficiently, right?
Exactly. The market used to look at Western Digital and see this messy mix of, volatile consumer flash memory and boring old hard drives. Capital allocation was a nightmare. Do you invest in fab capacity for flash or in R&D for magnetic heads? And they penalized the stock for that complexity. Now, the market is finally valuing the hard disk drive business as a standalone entity, and the financials completely validate that decision. Fiscal year 2025 revenue was up 51% year over year to $9.52 billion. But here's the key takeaway. Cloud revenue was up 36%. It is now 90% of their total revenue. This isn't a turnaround story anymore. This is an AI data cycle story.
That's a very clean narrative. But narratives don't pay the bills. Cash flows do. And I simply don't buy that the turnaround completely negates the business cycle. Yes, the spinoff provided clarity. Yes, the cloud numbers are impressive. But a 352% appreciation, that prices in every single piece of future good news and ignores any potential friction. You mentioned the revenue growth, but let's talk about the implied volatility. The IV rank is sitting at 99%.
Which just implies the market is expecting movement.
It implies the market is terrified. An IV rank of 99% means options premiums are more expensive than they have been 99% of the time over the past year. That's not just elevated. The options market is pricing in extreme turbulence, not the stability of a utility. If this were truly a safe, boring infrastructure play, like a water company or an electric grid, you would not see premiums bid up to these levels. The market knows this is a precarious height.
I interpret that fear differently. The IV is high because we're heading into earnings on January 29th, and the market is finally waking up to the margin potential here. Look at the profitability. Non-GAAP gross margins hit 41.3% in Q4. That's up 610 basis points year over year. That is the smoking gun that this isn't just about selling more drives. It's about a mix shift. They're selling high-capacity, high-margin enterprise drives, HAMR technology, 30 terabytes and up. They have disciplined the pricing because they are in a strict duopoly with Seagate. They aren't chasing volume, they're chasing value. And that margin expansion falls directly to the bottom line, which is why the PE re-rating is justified.
That margin expansion is fantastic execution, I'll give them that. But let's look at that valuation comparison you just hinted at. You want to justify the price based on the Seagate comparison, right?
Absolutely. It's the most direct arbitrage opportunity on the board. Western Digital is trading at roughly 31.2 times forward earnings. Seagate is trading at, 41.8 times. Why does that gap exist? Western Digital has actually surpassed Seagate in market cap, $77.4 billion versus $71 billion. They've matched them on operating margin at 21.1%. There is no fundamental reason for WDC to trade at a 10-point discount to its direct peer. If WDC just re-rates to parity with Seagate, we are looking at significant immediate upside. It's effectively free money sitting on the table as the market corrects that inefficiency.
Okay, that is a compelling argument if you live in a vacuum where only two companies exist. But I come at it from a different angle. You're comparing it to Seagate to make it look cheap. I look at Micron technology to make it look expensive. Micron trades at only 9.2 times forward earnings. Both are critical components of the AI data center. You need memory DRAM and flash, and you need mass storage. So why is the market treating HDD stability so generously compared to the memory oligopoly?
Because memory is chaotic.
It's cyclical, just like storage. If WDC is truly an AI component play, that premium over Micron is just unjustifiable. Memory is boom and bust, sure, but so is storage. The market is currently treating WDC like it's a software company with recurring revenue, when it's really just manufacturing hardware that depreciates the second it's plugged in.
I have to push back hard on that. The market dynamics are totally different. Memory, DRAM, and flash, that's an oligopoly with three major players who constantly engage in price wars to capture market share. It is violent. The HDD market is a rational duopoly between Western Digital and Seagate. Toshiba is a distant third. Pricing discipline has returned. That's why the market pays a premium for the predictability of HDD cash flows over the chaos of memory. And regarding Micron, they are dealing with the commoditization of consumer flash. WDC spun that business off. They got rid of the volatile piece. They are now a pure play on the one thing that AI needs that cannot be easily substituted: massive, cheap, energy-efficient capacity.
You mentioned the volume earlier, but I'm looking at the microstructure. We have a short interest of 10.86%. That's nearly 37 million shares sold short. You might call that potential fuel for a squeeze, but I see it as a massive vote of no confidence from sophisticated capital.
That is exactly why I'm bullish. Look at the days to cover ratio. It's sitting at 6.0.
Could you explain that metric for the listener who might not trade so actively?
Sure. Days to cover calculates how long it would take all the short sellers to buy back their shares based on the average daily trading volume. A ratio of 6.0 means it would take 6 full days of buying, assuming they could even find the shares, to exit their positions. So, if the earnings on January 29th are good, and the channel checks suggest they will be, those shorts are trapped. They rush for the exit simultaneously. That creates a tinderbox. And it gets even more interesting when you look at the dark pool data. The off-exchange short volume ratios have been frequently exceeding 60% in January. On January 12th, it was 64.07%.
And how do you interpret that? I mean, usually high short volume is bearish.
Not in this context. It's the dark index theory. When off-exchange short volume is that high during a raging uptrend, it usually signals institutional accumulation. Market makers are shorting the stock to hedge against the massive buy orders they're facilitating for institutions in the dark pools. They're selling to the institutions and then shorting the stock to stay delta neutral. So that high short volume number isn't bearish at all. It's a footprint of smart money buying without trying to spike the price.
That is a very convenient, bullish interpretation. But I offer an alternative reading. Look at the fails to deliver data, the FTDs. We saw a spike in December, over 121,000 shares on December 3rd alone.
Well, that's a relatively small number in the grand scheme of things.
It's the signal, not the size. When you combine high short interest with FTD spikes, It indicates tightness, sure, but it also indicates that the bears are stubborn. These aren't just retail traders punting on this, these are funds with high conviction that the stock is overvalued. They are willing to pay the borrow costs because they believe this cycle is about to turn. And frankly, with the stock up 350%, the risk-reward for a short position at 242 is a lot better than a long position. The higher you go, the thinner the air.
But who is on the other side of that trade? It's not just retail. We're seeing a clear rotation of shareholders. Bank of America added 7.6 million shares recently. That's a 41.9% increase in their position. Arcadio's Wealth added 44%. We're seeing smart money rotate out of general tech. JP Morgan sold some, for example, and into specialized AI infrastructure funds. The folks who understand the plumbing of the data center are buying.
You talk about smart money buying, but let's talk about the smartest money in the room. The insiders, the people who actually run the company. Do you know how many insider buys there have been in the last 6 months?
I haven't seen any significant buys, no.
0. Not one. But there have been 29 insider sales. The CEO, Irving Tan, sold 40,000 shares. That's $4.2 million taken off the table. If this stock was truly undervalued at $240 with a clear path to $380, as some models suggest, why is the CEO cashing out?
Okay, but context is key here. The stock is up 350%. Executives are human, they have to diversify, they have to pay taxes on vested shares. Selling $4 million when the market cap is $77 billion is a drop in the bucket. It doesn't signal a lack of faith in the business, it just signals normal portfolio management. The lack of buying is simply because the stock isn't at $50 anymore. They aren't going to average up when they're sitting on stock options priced much, much lower.
I think you're being too charitable. If the CEO thought this was the Amazon of storage in the early innings, he would not be selling. It is a red flag. It suggests that they know this is a cyclical peak. They know that hyperscalers like Amazon and Google double order during boom times and then cut capex to zero during digestion phases. We saw it in 2022, we saw it in 2018. Why is this time any different?
Because of the physics of the AI demand. This isn't just a normal capex cycle. Look at Polymarket. The contract for NVIDIA dominance is trading at 98%. The market is absolutely convinced that NVIDIA keeps selling GPUs. Physics dictates that if you have that much compute power, generating tokens and synthetic data, you need a place to put it. You can't store exabytes of training data on flash. It is simply too expensive. You have to put it on HDDs. WDC is a derivative beneficiary of NVIDIA's success. As long as the training wars between Google and OpenAI exist, and Polymarket shows that race is tight, no hyperscaler can afford to cut capex. They have to keep buying storage or they lose the arms race.
I agree that the correlation exists, but that sword cuts both ways. You're relying on a sympathy trade. If Polymarket probabilities for something like an AI regulatory pause or data center moratoriums start to tick up, and we are seeing rumblings of energy constraints, WDC will crash way before the analysts' downgrades come in. It's a derivative trade. If NVIDIA sneezes, Western Digital catches a cold. And you're ignoring the technological risk. You mentioned flash is too expensive. That is true today. But look at QLC and PLC flash, quad-level and penta-level cells.
Those technologies are still maturing. They're not there yet.
But they're advancing rapidly. If the price of NAND drops faster than expected, that cost advantage for HDDs erodes. The moat regarding price per terabyte isn't as deep as you think. If flash becomes cheap enough, warm storage moves to solid state, and the HDD market essentially vanishes.
The barrier to entry for mass capacity storage is incredibly high. And the timeline for flash parity is, it's essentially infinite at this scale. There are only 3 manufacturers globally: WDC, Seagate, and Toshiba. That's it. To switch from HDD to flash for warm storage would cost hyperscalers billions. It's not happening in this cycle. And WDC is ramping up HAMR drives, heat-assisted magnetic recording.
Right, for the uninitiated, that's using a tiny laser to heat the disk surface before writing data.
Exactly. It allows them to write data into much smaller, more stable magnetic grains. This pushes capacity to 30-40 terabytes per drive. That creates high switching costs. Once a data center qualifies a drive like that, they stick with it. That sticky revenue is what justifies the valuation.
Stickiness helps, but inventory digestion is the killer. Hyperscalers are buying hand over fist in 2025. History tells us that in 2026, they will pause to digest that capacity. If that happens, spot prices collapse, and that 41% gross margin you love so much will evaporate. We are looking at a company that is executing well, I grant you that. But the macro risks and the cyclical timing suggest we are closer to the end of the party than the beginning.
I just disagree on the timing. We're in the second inning of the AI build-out. The first inning was just chips. The second inning is infrastructure and data gravity. WDC is the landlord of the digital economy. As data gravity grows, they collect the rent.
Well, let's bring this to a conclusion then. We've got the earnings coming up on January 29th. How are you positioning?
I'm looking at the data, and I see a must-own utility for the AI age. The structural floor for me is at $220, right around that 50-day moving average. That is the buy zone. The valuation gap with Seagate is just too wide to ignore. That's free money on the table as it closes, and the short squeeze potential is real. With 6 days to cover, any positive surprise on earnings sends this stock vertical. My medium-term target is 280, driven by that multiple expansion and the realization that this is a structural growth story, not a cyclical one.
And I look at the exact same data and I see a trap. The turnaround is real, the spinoff was smart, but the risk-reward at 242 is poor. You're buying at the top of a parabolic move. I am watching that insider selling, and I'm watching the Ivy rank of 99%. Those are clear warning signs of a local top. I'd advise waiting. Let the euphoria cool off. There's a structural floor at the 200-day moving average around 188 to 190. That is where you buy a cyclical stock, when it reverts to the mean, not when it's 25% above it. We'll find out who's right very soon. The earnings on the 29th will be the moment of truth. Indeed. And for those listening, don't just take our word for it. Check the dark pool data. Watch the polymarket signals. The plumbing of the market often tells the story before the headlines do.
Absolutely. And as long as data gravity grows, the debate continues.
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya.